Imagine this for a moment. You sitting at home, scrolling through car listings, maybe at a Honda Civic you've been eyeing for months. Maybe a safe SUV for your family, or maybe even the sleek electric vehicle you've promised yourself you'd own one day, and suddenly you see the perfect one, the right price, the right mileage, and it's available today. Your heart beats a little faster, because you can already imagine driving it, smelling that new car leather, feeling that sense of upgrade in your life. But then reality smacks you in the face with one brutal question. How am I going to pay for it? And that single question is where the story of millions of Americans begins every year, because buying a car in the USA just about choosing a vehicle about choosing the right way to borrow money. And here is the shocking part. Almost everyone runs straight into the dealership financing office like sheep following a crowd, without realizing they actually have two powerful financial options on the table. The traditional car loan that almost every American knows about, and the lesser-known but incredibly strategic policy loan borrowed against your life insurance policy. One is familiar, predictable, and full of hidden traps, and the other is flexible, quiet, and extremely misunderstood. And in this video, I am going to pull the curtain back completely so you understand which option is truly best for you. Because one wrong choice here could cost you thousands of dollars over the next few years without you even realizing it. Now let's start with the option everyone knows. Car loans. They sound simple. Go to a bank, a credit union, or a dealership. You get approved. You choose your term, usually 36 to 84 months. You drive off the lot, and you pay monthly until it's yours. But here's the part nobody tells you. The moment you step into a dealership and say, I need financing, you entered their world, not yours. Your interest rate depends on your credit score, your down payment, your income, your debt-to-income ratio, the car you choose, and sometimes even what the dealership wants to charge you. So man with a 780 credit score might get a 4% APR. Someone with a 620 might get 12%. Someone with a 580 might get slapped with 20% interest or more. And the real trap, dealerships often make more money from financing than from selling the actual car. That's why they push loans so aggressively. They hide fees inside your contract, like documentation fees, gap insurance, extended warranties, and dealer aid-ins you never asked for. And by the time you sign the dotted line, you've agreed to a long-term relationship controlled entirely by the lender, where missing payments can destroy your credit and lead to repossession. The car isn't yours until the final payment is made. The lender owns it. That's the part most people don't understand until they fall behind and their car disappears in the middle of the night. But now comes the twist that flips the whole story. Policy loans. Most Americans don't even realize that if they have whole life or universal life insurance, they might be sitting on a quiet pile of cash value. They can borrow no bank, no dealer, no credit check, no approval, no questions asked. You simply request a loan from your insurance carrier, and the money shows up. It's like borrowing from yourself. And here's the part that feels almost unreal when you first hear it. You set your own repayment schedule. You decide if you want to pay monthly, once a year, or skip payments entirely without penalties. You can't get that freedom from any bank in America. No lender will say pay if you want. Don't pay if you don't want. But a policy loan says exactly that, because you're borrowing against your own asset. And unlike car loans, policy loans don't tank your credit score, don't put your car at risk, and don't force you into a fixed monthly obligation. But before you get too excited, here comes the suspense. Policy loans are powerful, but they're not a game. When you borrow against your life insurance, the insurance company uses your cash value as collateral. If you never repay the loan, your policy's cash value drops. If the loan grows too large with interest, your policy can collapse, meaning you lose your coverage. So yes, policy loans are flexible and empowering, but only for disciplined borrowers who understand how to manage debt responsibly. Now let's compare the two in real-world situations. Imagine you have bad credit. A dealership sees your credit score, shrugs, and offers you a 17% interest loan over 5 years. That could mean paying double the price of the car. But if you have a well-funded life insurance policy with, say, $15,000 or $20,000 in cash value, you could borrow at 5% or 6% with no credit check. you'd save thousands right away. Or imagine yourself employed with inconsistent monthly income. Car loans would stress you out because missing a payment is a disaster. But a policy loan gives you the freedom to pay when you can. Now flip the situation. Imagine you have excellent credit, 760 or above. The bank might offer you a low-interest car loan at 3% or 4%. In that case, it might be smarter to leave your policy cash value untouched so it can keep growing inside your policy. This is why this option isn't the same for everyone. It depends on your credit, your policy, your income rhythm, and your long-term goals. And here's where the suspense deepens. Think about this scenario. Someone goes to a dealership and buys a $30,000 car at 8% APR for 72 months. They end up paying more than $37,000 by the time the loan is done. Meanwhile, someone else uses a policy loan to buy the exact same car at 5% interest with flexible payments and ends up paying maybe $32,000 total. One person pays the bank, the other person pays themselves. One person is stressed every month. The other person controls their own repayment. These choices literally create two different financial realities for people who buy the same exact car. Another twist. Policy loans sometimes charge simple interest, while car loans charge compound interest. That means over time, car loans cost more. Yet, here's another suspense-filled truth. If someone takes too large a policy loan and completely ignores repayment for years, the interest compounds and can threaten the policy. So using policy loans requires maturity and financial awareness. This is why wealthy Americans use policy loans all the time. They understand the discipline required. But here's the question you should be asking right now. Which option is truly best for you? Not for your neighbor, not for your cousin, not for someone on TikTok. If you're someone with inconsistent income, a policy loan gives you flexibility. If you're someone with strong credit and stable finances, a car loan might be cheaper. If you want ownership and control, policy loans win. If you want predictability and structure, car loans might be better. If your policy is brand new, don't use it. If it's mature with strong cash value, it can be a secret weapon. And now here is the final truth nobody talks about. Dealerships want you to take a car loan. Banks want you to take a car loan. But a policy loan puts the power back into your hands. You're borrowing from your own financial foundation instead of giving profits to a lender. Most Americans don't even know this option exists. That is why you're already ahead of millions of people, because now you know both options and how they work. And finally, here is your call to action. If you want me to break down your specific situation, your credit score, your income, your policy, your financial goals, drop a comment below. I respond personally to help you make the smartest choice for you. And if this video helped you understand something that schools, banks, and dealerships never teach, hit like, subscribe, and turn on notifications. Because here on Life Insurance USA, I break down the hidden financial tools that protect families, save money, and give you real financial control. Your future begins with knowledge, and now you have it. I'll see you in the next video.